Right now, NVIDIA stock is trading at exactly $216 per share, showing an intraday gain of $1.50, which translates to a 0.7% move upward in the current session. But while most retail traders are staring at this modest tick upward, calculating minor daily percentage changes on their phone screens, something far deeper is taking place behind the scenes. Heavy volume blocks are shifting quietly, and institutional funds are positioning themselves in ways that suggest this short-term consolidation might be a massive camouflage for the next leg of core chip demand. If you are tracking this through standard online investment channels or using a regular individual brokerage account, you might just see a stock that is hovering below its recent 52-week high of $236. The real insight that most casual observers miss, however, is that the current trading range reflects a massive tug-of-war between short-term margin pressures and an insatiable institutional appetite for hardware backlogs. The options market is currently pricing in a severe volatility squeeze, which means the quiet behavior we are observing at this specific price point is unlikely to last much longer. The general sentiment surrounding NVIDIA stock right now is one of cautious hesitation. People assume that because the initial explosive chip rush has normalized into predictable corporate capital expenditure budgets, the massive growth spurts are behind us. The common narrative on popular investing sites and retail financial forums suggests that competitors are catching up and that mega-cap technology firms will eventually find alternatives to avoid paying the steep premium that NVIDIA commands for its data center architecture. This is the expectation. The reality, however, is that software ecosystems are far stickier than hardware competitors admit. When a developer builds an enterprise application, they are not just buying a chip, they are locking themselves into proprietary software frameworks that make switching to alternative silicon economically unfeasible. This architecture creates a massive barrier to entry that standard hardware metrics fail to capture. While the retail crowd is debating whether to buy fractional shares on their Robinhood app or check automated allocations within a Schwab Intelligent Portfolio setup, massive sovereign wealth funds and institutional players are executing massive block trades, recognizing that the computational backbone of the entire corporate world is still entirely reliant on one single source. Let us unpack the raw trading volume and institutional footprint that we have witnessed over the last several sessions. Yesterday, the stock experienced a significant intraday swing, touching a high of $221.60 before dipping down to a low of $210.97, eventually finding its footing to close higher. That massive $11 trading channel occurred on volume that exceeded standard moving averages, a classic sign that large-scale institutional accumulation is happening on the dips. When you see a stock refuse to break down below key support levels despite broader macroeconomic headwinds and rising interest rate anxieties, it tells you that major wealth managers are stepped in to defend the floor. Institutional tracking reports indicate that firms like Fidelity Investments and specialized tech-focused exchange-traded funds have been subtly rebalancing their portfolios, absorbing the selling pressure from short-term retail traders who are panic-selling small chunks of their holdings. This churn of shares from weak hands to strong hands is exactly how sustainable long-term support levels are built, changing the landscape before the next major upward trend begins. If you look at the broader sector momentum, the entire semiconductor landscape is undergoing a massive structural shift. It is no longer just about who can produce the smallest chip architecture. It is about who can guarantee the delivery of massive integrated clusters of data systems at scale. This is where the gap between expectation and reality widens significantly. Retail investors using basic online investing tools often look at trailing price-to-earnings ratios and conclude that the stock is wildly overvalued compared to legacy chipmakers. But sophisticated institutional asset managers utilizing an advanced interactive brokers trading setup look at leading cash flow generation metrics and structural return on equity, which currently sits at an astonishing 114%. This massive profitability means that the company is essentially printing cash faster than it can spend it on research and development, allowing it to widen its competitive moat every single day. While alternative tech companies struggle with tight operating margins, this particular business model functions like an outsourced utility for the entire computational infrastructure of the modern world. Comment below how many shares of NVIDIA stock you currently hold, or if you are waiting for a deeper pullback to enter the market. Hearing where the community stands helps us gauge whether retail sentiment is aligned with what the big funds are doing behind closed doors. To truly understand why the current market movement is so significant, we have to look back at how this business model was originally constructed and how its past financial performance set the stage for its current dominance. Long before every retail trader was talking about artificial intelligence or downloading the latest Robinhood stock trading update, this firm was quietly perfecting parallel processing architecture. Originally designed to handle complex graphic rendering for video games, they realized early on that the mathematics required to render a pixel on a screen are fundamentally identical to the mathematics required to process massive datasets, run complex algorithmic simulations, and train complex neural networks. While traditional central processing units handle tasks sequentially, one after another, graphics processing units split tasks into thousands of smaller pieces and solve them simultaneously.
This structural design choice made decades ago is the primary reason why the company holds a near monopoly on high-performance computing clusters today. They didn't just stumble into a lucrative market, they spent 20 years building the precise hardware and software ecosystem that the world would eventually realize it desperately needed. This brings us to the core business model, which is frequently misunderstood by casual observers who view it simply as a component manufacturer. The true value lies within the software stack, known as CUDA. For years, developers have written their parallel computing applications specifically for this platform. If an enterprise wants to switch to a cheaper competitor chip, they can't just swap out the hardware. They have to rewrite millions of lines of proprietary code that was optimized for this specific software ecosystem. This creates an incredibly powerful consumer lock-in effect. It is a brilliant business model where the hardware acts as the distribution mechanism, but the software acts as the economic fortress protecting the profit margins. This is why the gross profit margins remain consistently above 62%, a figure that is practically unheard of in traditional hardware manufacturing. When you look at old corporate financial statements from a few years ago, you can trace this steady progression from a gaming-centric business to a dominant infrastructure enterprise, with data center revenue completely eclipsing every other segment of the company. Now let us analyze the structural macroeconomic pressures and sector dynamics that will shape the intermediate future. We are currently watching major cloud service providers enter a phase where they must prove to their own shareholders that the massive capital expenditures they have funneled into data center infrastructure are yielding real-world revenue. This creates a fascinating tension in the market. The skeptics believe that if these cloud giants slow down their spending, chip orders will collapse, sending the stock tumbling back down toward its 52-week low of $138. The counterargument, and the reality that seems to be playing out in recent order books, is that corporate enterprise demand is expanding beyond just the major cloud hyperscalers. Traditional industries ranging from healthcare and automotive logistics to financial service firms using specialized Fidelity brokerage accounts are now realizing they need to build their own localized proprietary computing models to remain competitive. This secondary wave of enterprise adoption is quietly offsetting any potential normalization from the massive consumer tech giants, creating a structural demand floor that the market has not fully accounted for in current valuation models. Looking ahead, there are several distinct future scenarios and catalysts that long-term investors need to weigh carefully. In the best-case scenario, the next generation of architecture chips will launch smoothly without any supply chain bottlenecks or design flaws, instantly triggering a massive upgrade cycle across every major data center globally. Because the performance gains of these newer architectures are so significant, enterprise clients cannot afford to delay adoption without risking falling behind their direct competitors. This structural compulsion to upgrade could drive another massive wave of revenue growth that would completely invalidate current analyst projections, pushing the stock well past its previous record highs. And on the flip side, the primary risk scenario involves intense geopolitical friction surrounding semiconductor supply lines. Because chip fabrication remains concentrated within highly specialized geographic zones, any disruption to global trade routes or manufacturing facilities would immediately restrict supply, leaving massive order backlogs unfulfilled and putting immense pressure on short-term stock performance. Furthermore, investors must watch the ongoing regulatory environment very closely. As sovereign nations begin to view computational power as a matter of national security and economic infrastructure, we are seeing stricter export controls and deeper antitrust scrutiny across the globe. This regulatory friction could limit the total addressable market in certain international regions, forcing the company to constantly adopt its product lines to meet complex legal frameworks. For retail traders managing an active portfolio through a SOFA active investing app or balancing long-term retirement funds inside Fidelity IRAs, these macroeconomic shifts highlight the absolute necessity of looking beyond daily price ticks. The expectation is that global growth will be linear and uninterrupted. The reality is that navigating international trade policy and supply chain diversification will require immense operational flexibility and could introduce sudden bouts of volatility into the technology sector. When we look closely at how modern investors are approaching this asset, the choice of platform and methodology reveals a lot about market positioning. Investors who rely entirely on automated systems like a SOFA robo-advisor or standard passive index funds are buying this stock simply because of its massive market capitalization weight, blindly tracking its ups and downs without any regard for underlying valuation cycles. On the other hand, self-investing individuals using advanced Fidelity trading platform tools or interactive brokers platform metrics are attempting to actively time these consolidation patterns, looking for precise technical entry points where institutional block buying signals a reversal. This structural division between passive programmatic buying and active institutional accumulation creates unique liquidity pockets where the stock can suddenly move sharply on seemingly minor news, catching unprepared market participants completely off guard. Ultimately, the story of this technology powerhouse remains an elegant study in the classic tension between short-term market expectations and long-term industrial reality. The market frequently gets caught up in a cycle of emotional extremes, swinging wildly from irrational exuberance during massive earnings beats to intense anxiety whenever a quarterly report shows a slight normalization in growth rates. But when you step back from the daily noise of the trading floor, the structural fundamentals tell a remarkably consistent story. The world is experiencing an unprecedented expansion in its total demand for raw computational power, and the infrastructure required to support that expansion is overwhelmingly built on one single foundation. While alternative platforms and new investing sites will continue to offer retail traders endless ways to trade the stock, the long-term destination of the enterprise will be determined by its ability to maintain its massive software mode and deliver its hardware backlogs efficiently. To bring this full circle, let us look back at the core insights we explored today. We started with the current intraday price action of $216, noting that while the surface level movement seems quiet, the underlying volume trends point towards significant institutional positioning. We challenge the common expectation that competitive chip makers will easily erode this market share by revealing the immense structural stickiness of the software architecture ecosystem. We examined the robust corporate financials, highlighted by an extraordinary return on equity and strong gross profit margins that past reports clearly substantiate, and we mapped out the critical catalysts and global supply risks that will dictate the next major market phase. Whether you are managing your capital through a premium Fidelity wealth management account, checking your allocations on a Robinhood app, or running detailed technical charts via interactive brokers, true clarity comes from ignoring the emotional narratives and focusing entirely on where corporate capital is actually flowing. The gap between what the crowd expects and what reality delivers is where the real market opportunities always hide. Disclaimer, this video is for educational purposes only, not financial advice. Please do your own research before investing. Market involves risk. Like this video, comment your thoughts, share with your friends, subscribe for more updates.